Good afternoon, everyone. We're Firethorn Partners, and we're excited to present two investment opportunities to you today. We'll be discussing the St. Paul Plaza and the Jane Hotel. We'll go over our market and financial analysis and our investment decision for the fund. Now, Highland Capital II is an opportunistic front-end fund targeting real estate investments with a 17% LP levered return and a 1.7 equity multiple over a 3 to 7 year hold. Now, our investment approach is structured and proprietary. This approach allows us to capture the most value for our investors while limiting downside. So first, we focus on partner strength. Our partners are best-in-class operators. They have a proven track record in their submarket and asset class. Second, we have a quality bias. We invest in real estate with undeniable great locations and a high-quality physical plant. And third, we're opportunistic investors. We source investments with high quality value add potential through operational and physical improvements. Now, through our approach and through our financial and market analysis, we highly recommend passing on St. Paul Plaza, a 45-year-old Class B suburban deal. And we highly recommend investing in the Jane Hotel, a boutique, historic hotel in a vibrant central business district in a gateway city, Dune City. Now, before we walk you through these investments, we want to take a step back and assess the current suburban office market. As national employment reaches full capacity, job growth will slow down, and demand for office space and absorption will decrease. During our hold period, cap rates are expected to expand, and as we all know, cap rates expand at a much faster pace for suburban markets and Class B product. And most importantly, most top 10 MSA suburban office markets are currently in the peaking phase of the cycle and rapidly approaching the falling phase. We believe most value investments in the suburban office market were made 48 to 60 months ago, not today.
So I'm going to walk us through our first option, which was St. Paul Plaza. And St. Paul is a 545,000 square foot Class B suburban office building located in Oakdale Park. It's 90% occupied and has above market rents of $20 per square foot in a supply constrained market. And despite some favorable characteristics, we decided to pass on this deal. And it really boils down to our investment approach. With a limited capital budget of $2.5 million and a building that's already 90% occupied, where are we going to add value to this deal? We're an opportunistic fund, so this just doesn't fit our fund model. You'll see we have 450,000 square feet of unused FAR, but current office dynamics do not call for development, so we're not going to add value there either. We also have an unproven partner in the marketplace. Great Lakes Partners, our operating partner on this deal, has never worked in this marketplace before, and we want someone who knows the ins and outs of the market and can execute on our vision. There's also too much risk on this deal. We had to lever up to 80% just to hit our fund level returns, and there's significant rollover risk in year 6 with Southwest Equities. Just made it too risky for us. So here are the JV terms that Great Lakes Partners approached us with. And you'll see that they asked for a capital contribution of a 90-10 split, with us providing 90% of the equity, and a pretty attractive promote for them. And we're actually okay with both of these, as we believe that the capital contribution aligns interests and the promote incentivizes and really maximizes performance. We did push back on the property management fee. We felt that 3.5%, we wanted more in line with market at 3%, considering our high cash-on-cash returns. And we also increased the liquidity lockout from 36 months to 60 months, which is in line with which is coterminous with our loan maturity and our hold period. We really don't want to be scrambling to find an operating partner while we're trying to execute on this deal. So we had two debt options for this project. We had bank debt of 3 years with two 12-month extensions at 60% loan to cost, and we had CMBS debt, 5 years at 80% loan to cost. And we wanted to go with the bank debt. We're more comfortable with that 60% leverage. It's right in our wheelhouse, but it just didn't get us there on fund level returns of 17% IRR and 1.7 equity multiple. So we had to go with the CMBS debt if we wanted to do this deal of 80% leverage loan to cost. That made us very uncomfortable, and it was one of the main reasons why we passed on this deal.
Now we'd like to take a moment to walk you through the financials of the deal. Our total capitalization is just under $130 million. However, what I really want to draw your attention to is the yield on cost of 7.63%. This happens to be 90 basis points below our projected exit cap. This fact in and of itself makes us want to turn and run from the deal. Now, one of the positives we did see in this was the solid net operating income for the duration of the holding period, but there's a huge lack of growth in it. It would be a great cash play for a core plus fund or a cash-focused company like PIMCO, but given the lack of a value add opportunity coupled with the exit risks, we just did not see a point in going forward with this. Next, I'd like to talk about our property underwriting assumptions. We underwrote rents to $20 a square foot, triple net, with an annual rent growth of 2.5%. These assumptions resulted in a project-level IRR of 19.63%, with an IRR to the fund of 17.08% and an equity multiple of 1.84 times. You'll see from the sensitivity table at the bottom right that any exit occurring prior to 60 months drastically reduces our returns. Now that I've walked you through some of the financials, I'd like to discuss some other factors that played into the decision. We all know that tenant needs have been evolving over the last few years from a strictly work environment to more of a live, work, play environment. Now, if we're going to invest in office, we want to be able to check all of these boxes you see before you. With our minimal CapEx budget, our limited ability to incorporate these components into the deal was a big weakness in the opportunity in our eyes. Lastly, I'd like to talk about everyone's favorite topic, millennials. Now, walkability and distance from the office are two of the most important criteria when deciding where to work for that group. They're going to make up half of the workforce by 2020, and with this group wanting to live in the country's cities, the future of the St. Paul Plaza looks very bleak, with it lying 20 miles outside the nearest CBD.
So in conclusion, this is just not the deal for us. We're opportunistic investors, and we don't really see how we're going to add value with a building that's already 90% occupied and a limited $2.5 million capital budget. We also don't like that our operating partner has never worked in this market before. We want someone who knows the ins and outs of the market, and we believe that Great Lakes Partners is not the ideal partner for us. Finally, there's just way too much risk. 80% leverage with roughly 1/3 of our rent roll rolling in year 6. We have to renew Southwest Equities. If we don't, we're stuck with a Class B suburban office building that's 60% occupied. That's going to drastically shrink our buyer pool and make our exit incredibly difficult. The last thing we want to do is hold on to this asset for too long and give the keys back to the lender.
So before turning to the Jane and discussing why we think it's a much more attractive deal than St. Paul, we should spend a minute or two talking about the U.S. hotel market. The upscale and luxury portion of the market that we're most focused on is divided into 3 key segments: boutique, lifestyle, and soft brands. Our hotel, the Jane, is a boutique hotel characterized by its focus on quality and its independence from a traditional national flag. While the boutique hotel segment captures the highest revenue on a per room basis, it also tends to fall the farthest in a downturn due in part to limited marketing budgets. So to address this issue, we're actually going to soft brand the Jane in order to, 1, tap into the Marriott's 85 million member reward system to protect us on the downside, while 2, protecting our operational independence and historic brand. So today we often read that the hotel market in the US is at the peak or just past the peak. Average cap rates have been expanding since hitting lows in 2014, and hotel REIT acquisition volumes fell to their lowest levels since 2009 last quarter. However, we're comforted by the fact that foreign capital still has an incredible appetite for US hotels. Foreign institutions have accounted for nearly 1/3 of US hotel acquisitions so far this year, and we believe that if there is a downturn in the US, foreign capital will continue to seek yield and high quality US assets like the Jane Hotel. We're also comforted by the data in the bottom right that suggests that in the top 25 US markets, RevPAR is holding steady in the face of declines across the rest of the country. So recently, we've heard a lot about this hotel killer that is Airbnb, but we don't think the data really suggests that Airbnb poses a significant risk to this kind of the luxury end of the hotel market. Airbnb targets the leisure traveler, which accounts for 90% of their revenue. They also target longer stays. The Airbnb average is 17 days. Hotels like the Jane target an entirely different segment of the market. 3/4 of hotel revenue comes from business travelers staying on average just 2 days. Finally, Airbnb faces significant regulatory pressures across the US as well. Gateway cities, much like Dune City where the Jane is located, face an affordability crisis, and local governments are really pushing back against Airbnb in order to address this issue of affordability. Just this June, actually, New York banned the listing of full apartments for fewer than 30 days in the hopes that landlords would be forced to bring these units to market and thus increase the housing stock. This regulation alone means that 54% of Airbnb's New York listings became illegal literally overnight. Much to the delight of the hotel industry, similar laws are being enacted in other large US cities, including San Francisco, LA, Austin, Miami, and Chicago. And the lodging industry will continue to watch and see how other large cities deal with this issue of affordability.
And now I'd love to tell you more about the Jane Hotel. The Jane is an 1898 vintage, 120-key historic hotel. It is truly one of a kind. The asset's located in the A+ Gateway submarket of Dune City and is walking distance from 35 million square feet of office inventory in the financial services district, 2 major convention centers that bring 850,000 guests to Dune City every year, and plentiful street retail. Now, although the asset was constructed in 1898, it was previously renovated in 2006 by the previous owner, in which they converted the asset from office to hotel use, and in the process over-improved all of the guest amenities and interior finishes. As such, we're able to acquire the building with very little to no obsolescence. However, because of their high cost basis, they're currently managing the building passively and not getting the yield they need. So, the building is currently underperforming the market comps in terms of both occupancy and ADR. Sutherland brought us this deal, and we have a phenomenal working history together, very successful JV history. So when the two of us put our heads together and we looked at the Jane, we saw an incredible opportunity to bring in a best-in-class property manager, incentivize them, and capture the value in this one-of-a-kind, irreplaceable asset. Now, we typically don't push back on the JV terms when we have a sponsor that we have a very good track record with, and this has worked for us in the past. So very traditional, we're going to split the equity check 90-10. They're going to cover all cost overruns here. The promote structure is very aggressive, but we also want to share in the upside, and we want the entire team to win if this deal goes well. You will notice, however, that we do want to come up with a customized property management structure for our operator, Gemini, in this case, because hotels are a very operationally intensive product type. I'm going to touch on that shortly here. But you'll also lastly notice that on our liquidity lockout, we're going to ask for a 48-month duration to coincide with our 48-month loan term, our 48-month preferred hold period, and allow us to extract the maximum value from this asset prior to exit. Now, to lever our position here, we pulled 2 different debt quotes. The first was from a bank, the second from a debt fund. The bank's 3-year IO, 55% loan-to-cost leverage, also came with 10% recourse, which for us was a non-starter. Furthermore, it starts to amortize in month 37. On the other hand, the debt fund's 48-month term aligned perfectly with our preferred 4-year hold period, was IO for the entire period, gave us a little bit more juice at 65% loan-to-cost, and furthermore had no recourse. Easy decision for us to move forward on the debt fund. Now, incentivizing the property manager here is critical to the success of this deal. We feel this is the biggest part. So what we're going to do is actually take that traditional 2 to 3% structure that gives Gemini, our operator, 2 to 3% of the revenue. We're actually going to bump that up, and we're going to do that because we want to share in the upside and actually promote outperformance on their part. So what happens is, as soon as they hit 100% or greater RevPAR penetration, they're actually going to get a boosted earnings to their company, and they're going to make a lot more money than they currently are. Now, to capitalize this asset, we're going to lever about $51 million in upfront costs at about 65%. We're going to draw $3 million additionally over months 1 through 24 in that loan facility. And then what we're going to do is exit in month 48. Now, I really want to draw your attention here to the yield on cost on the screen you now see. It's a 7.6%. To put things into perspective for you, our going-in cap rate on this asset is a 5.3. We took a very, very conservative approach to our underwriting here because, as of you, we're also projecting an interest rate increase along with cap rates, and 4 years is a long time to predict. We grew our going-in cap by 130 basis points, so we're actually exiting around a 6.6. With that yield on cost, we're still 100 basis points above that exit cap, so we're very comfortable with our underwriting on this deal. Now, our cash-on-cash equity multiple here is actually going to grow from about a 7 to an 11% over 4 years, at which that time we're also going to return $19 million to equity investors. So you're probably wondering, what does Gemini have to do to succeed in this case? Well, we're actually going to set up 2 key KPIs for them to achieve on day 1 of closing. The first of those is that they're going to have to grow occupancy of the Jane up to that of the market comps by year 2. Secondly, they're going to have to grow their RevPAR penetration of this asset to 105% minimum by year 4 when we exit. If they do both of those things, And when you look at the incentive structure that we're going to give them, they're probably going to be able to retire after this deal. But the big thing is we're going to hit a 17.5 levered IRR to our fund. We're going to get a 1.8x equity multiple, and all the investors on this deal are going to go home happy. I'd also like to point out that our exit here has a lot more flexibility built in relative to the St. Paul asset in terms of both exit cap rate and our hold period, which is something we also really like. Let's take one step back real quick and look at both these deals one more time. Kenny touched on some of the risks associated with St. Paul, and I talked about all the things about the Jane that we really like. But with our fund, we try to protect the downside, and we let the upside take care of itself. The upside is very lucrative in both these cases, but the downside on the St. Paul is just too much risk for us. The biggest thing I want to draw your attention to on this slide is where we're buying these assets at relative to market pricing. On the St. Paul, we'd have to be paying a 4% premium on a building that's nearly 50 years old and 20 miles outside of the CBD. On the Jane, however, we have the opportunity to buy a one-of-a-kind, irreplaceable asset that was built in 1898. Furthermore, we can get this deal at a 24% discount to market valuation right now. We don't have to exit at a premium to the market valuation. And the best part is we have a best-in-class sponsor and operator ready to go on this deal. We're ready to pull the trigger on the Jane. We hope you'll take that ride with us. And now Kim's going to walk you through our vision for the all-new Jane Hotel.
Right. Now, I'm going to focus on our fund's third core investment criteria, which is upside potential. We see so much value add potential in the Jane, and we are really excited to work with our best-in-class partner and our operator to really improve operational performance and reposition the asset to bring new life to the heart of the city. First, we are choosing to soft brand the Jane by aligning ourselves with Marriott's luxury soft brand, the Autograph Collection. Soft branding is not an end to distinctiveness, rather it is a path to profitability. Currently, the Jane receives 50% of its bookings through OTAs, which charge a 20% commission. On the other hand, the Marriott, by booking directly through the Marriott, you are only charged a 6% commission. In addition, the Jane will receive all of the benefits of Marriott's expanded customer base and access to the Reward Points loyalty program for travelers, which will give us access to their high-end business travelers. All the while, the Jane will maintain operational autonomy, and we will be hedging risk in the face of a downturn. Now, I would like for you to dream with me for a moment. You are a professional living a fast-paced life, working in the heart of the city in the financial district. You love a restaurant that captures the essence of your city, that serves your favorite local beer on tap, that sources its food locally, and that provides you with a walkable, quick, and healthy option for breakfast, lunch, and dinner. You want someplace where you can have a client meeting, host a corporate meeting, or just stop by after work for a happy hour. Now, what if we could give you all of this in a historic 1898 building? The Jane's new farm-to-market food and beverage concept is going to offer you all of this and more. In addition to our improved food and beverage concept, the Jane is going to be focused on targeting 3 specific customer segments. First, as we mentioned, we will be targeting the high-end business traveler. By doing this, we are going to invest in our executive meeting space and invest in better technology to increase efficiency for our travelers. We're also going to be looking at targeting leisure travelers by hosting a celebrated weekend brunch and a relaxed happy hour on our new rooftop patio. And finally, we want to be able to cater to special events. So if you're hosting a convention at the nearby convention center, or looking to just have a corporate meeting, or you're looking to have an intimate and memorable wedding, the Jane is able to cater to your every need. And finally, to bring the repositioning of the Jane home, we want to make sure that each of our customers has a personalized experience. So whatever your agenda, when you're staying at the Jane, you will be experiencing the essence of the city, in the heart of the city, on your schedule. It's only a matter of time before you hear everyone in town saying, "Hey, meet me at the Jane." Thank you.
So with that, we're open to any questions you may have.
Don't be shy.
You have a pretty aggressive food and beverage plan for the hotel, but aren't you really just going to sublease it or lease it to another third-party operator?
Yes, we are, but we were looking at examples such as Founding Farmers in DC that really target all of those. They lease their spaces as well, but they also really target the craft coffee, the local food, the happy hour, and they bring in a lot of business travelers.
On the office building, it seems like you had a lot of really good ideas for what you could do to it to make it attractive as a suburban location to tenants. Did y'all run any scenarios where you increase the capital budget to create that wow factor and see what the returns would be?
We did consider that. However, due to the limited capital budget of $2.5 million, it just wasn't enough and wasn't feasible in today's market to really absorb and capture that value. We think that in the next 5 to 6 years, it would be a fantastic opportunity, but today it just wasn't feasible.
And to add on to that, I mean, we're buying it at kind of top of the market, 90% occupied. We really felt uncomfortable with the CMBS debt, and so levering it up to 80% just to hit our fund returns, while putting in more capex to completely redo it would just make this even riskier in our opinion. So we did kind of play around with it, but ultimately decided it didn't hit our fund model.
All right, if there are no further questions, thank you, Firethorn Partners.